I mean, there can be no doubt about the fact that we are in the midst of a global bull market now. I mean, the
Mhm.
Nasdaq's already at a high. US indices are nearing their highs as well, and
Yes.
corrections are getting bought into. I mean, the screen is a pure bull market screen globally. There can be no doubt about that.
Mhm.
So I think at this point in time, everybody is focused on the price action on the screen because the other cues are not very sanguine. Nobody knows where the economy is headed globally, where the earnings data will be 6 9 months from now. But the one thing which is strong is liquidity, and the one thing which is very strong is price action on the screen. And sometimes when there is a lot of confusion around, investors actually rely on the screen or the market to tell you which direction to proceed in.
Mhm.
And in March, the screen was a pure bear market screen. And right now, there can be no doubt that the screen is actually flashing bright green bull market. So all that one can say at this point in time is that you have to participate in this market, because if you sit out, then you miss
Yes.
out big time in one of the most powerful rallies we've seen in recent years in the stock market. And that's
Mhm.
likely to lead to a lot of anguish. So participation is mandatory, because otherwise you will actually feel very badly left out with your portfolio. Having
Mhm.
said that, your guide to participation right now is price action on the screen. And every time when you use the price as a gauge or the price as your guide, you need to be very, very nimble, because the price action changes very quickly. And in March, the price was telling you something else. In June, it is telling you something else. Again, 3 months down the line, maybe the price will change once again. It can.
Mhm.
I'm not saying
Mhm.
it will. And
Yes.
therefore, you need to be very alert and very vigilant, because this is not a clean earnings uptrend trajectory that you're trading. Far from
Yes.
it. So, in this kind of a time when liquidity and global price action are your guides, all one can say is participate, but be vigilant and be close to the door, so that if the tune changes for some reason, you can exit as quickly as you got into the market. Otherwise, I guess at this point, there is no point arguing with the market. It is telling you
Mhm.
it is in very, very bullish terrain. Well, this quarter results will be a washout, and I don't think it will move the needle too much at all for the
Mhm.
market. If that was the case, then the market would actually not be rallying into the results,
Mhm.
because the results will not be good. We all know it was the result of the lockdown period, and the results will probably be the worst that we've seen in a very, very long time, if ever.
Mhm.
But that is not going to worry the market, because it is a known factor, and therefore the market will not fall when earnings are very bad. I think
Right.
more than the earnings, what will matter is what the managements are saying about where they have reached with restoration of normalcy in the unlock period. If they have got back to 75 80% of maybe what they were doing in January and February, are they facing problems with staffing in their factories? Have
Mhm.
enough people, workers, come back after going back from the cities? Or what kind of logistical problems, or have they been able to surmount those logistical problems? Are they confident that even if there is some disruption in the July to September quarter, in the October December quarter, things will be much better? In fact, very close to the January February kind of numbers. That
Right.
is the key thing. The market always looks forward. What
Mhm.
you're going to be presented now is backward looking data, which is going to be very bad. So I don't think this quarter's earnings, however bad they will be, will make any material difference to stock prices. In fact, you may find that stock prices actually go up when the earnings are bad, because
Mhm. Mhm.
it's almost to say that this is not what we are focused on. We are focused on the future. So focus on the commentary, focus on what the managements are saying about the next quarter, not necessarily even the current quarter.
Right.
If the managements come out and say that they are still feeling very uncertain,
Mhm.
and it will take much longer than what the stock market thinks to get back to 100% normalcy, that's something which can potentially derail market sentiment, but not the numbers per se. Of course, there is global liquidity, but I don't think this market is rallying only on the back of global flows. I
Mhm.
mean, I think it would be a folly to think like that, because
Mhm.
you take the example of the last 5 days. FIIs bought on Friday, but throughout the rest of last week, they were actually net sellers on every day. But the
Mhm.
market did not correct, did it?
Right.
Market continues to stay at 10,500, 600 plus. and is now breaking out of that as soon as the first sign that FI selling might have abated in the near term. I think there's a lot of local liquidity which is also getting into the market, which is evident in the way mid caps and small caps are rallying. I mean, you see stocks rallying 20%, hitting 20% circuits at a time like this, which is telling you that this is not just a pure FII-led rally. Domestic participation is beginning to open up, and that is leading to the broader market participating in the tremendous momentum. Now, a lot of questionable quality stocks are moving up because of that, and you should be wary of that. I don't know whether that means this is the crescendo kind of a thing when the market is in, at least in the near term, the last leg of this rally, which started at 7,500, because a lot of cats and dogs have started to move up in the last few days. But I think now it has become, initially it might have been the FII rally, but now the local money is getting sucked into the rally, and which is leading to participation in the broader market of the CNX 500 as well. So liquidity, yes, but liquidity is coming in because of the premise that the market and earnings will normalize sooner than what the market had feared in the month of March and April. And we'll have to see as time goes by whether that assessment of the market is actually proved to be correct. Well, it's a time of utter confusion, and it's a time of unprecedented confusion, I would say, because we've seen bear markets and bull markets in the past. I mean, none of us are newcomers to the fact that stock prices fall and stock prices rally. And sometimes it is difficult to say where a bear market ended and when a bull market started. And hindsight tells you that when the transition or the handover took place. But we haven't seen for many years, for a very long time, for decades, this kind of price action where a sudden panic event leads to a catastrophic 40% fall. And then within the next 3 months, we have a 40% plus rally in the market once again, and with the market broadening out, and most people concluding that a bull market has started from the ashes of that bear market, which was very brief. So it's a time of utter confusion. I'm totally confused myself on where things will head from here on, because the underlying conditions for earnings still remain very, very dodgy and tricky and uncertain. So we don't know when this rally or where this continues, whether it takes us close to the old highs, whether it suddenly fizzles out because of some global event and triggers another massive correction in prices. The best that one can say, as I said, is participate, but be vigilant and alert and nimble, and be prepared to change your stance if the screen tells you otherwise, because you're being guided by the stock prices. And if stock prices tell you another or send out another signal from the screen, then you should change your stance as well. It doesn't pay in this kind of a condition or underlying condition to take a very hard stance on things and stick to it, because you will rue that kind of positioning. At this point, be flexible, be guided by the market, and change as conditions change. To come out with any kind of advice at this point in time, because as I said, I'm very confused myself about how things would move. You are more confident handing out advice when you have a better grip about the earnings trajectory. Because I respect price action on the screen a lot, because the market often tells you things which is more than what your head can wrap itself around. And you have to respect what the screen is telling you, and I do that. But you actually are far more confident when you have a better handle on earnings, because that is an article of faith with me, that finally stock prices will follow earnings. It may ignore GDP prints, it may ignore the economic conditions, but it does not ignore the earnings trajectory beyond the point. So once one gets a better handle on whether after 5 years of an earnings recession in India, or a virtual earnings recession in India, whether the time has come once again for earnings to expand over the next 4 or 5 years. If the answer to that was yes, and was visibly yes to me, I would have been far more confident in saying that this is the time to keep adding exposure at every decline in the market, because after many years, the bull market has started again. So the price action is suggesting that, but I don't have enough conviction in earnings picture yet to go out and give that advice yet. So I remain confused, and I remain open to various kinds of possibilities. And if there's one thing that the markets taught me this year, is that don't take very hard positions, uh, and be ready to accept what the market is about to tell you in a situation which is so unprecedented, or as unprecedented as we've seen in our lifetimes.